Good morning, everyone. Thank you so much for attending our webinar today on SPACs in Asia Pacific. My name is Frank Troise, and I am the CEO and Managing Director of SoHo Advisors. And I couldn't be more honored today to have with me Michael Gould from PwC in Chicago. Michael, thank you so much for participating today.
You're welcome.
So Michael, just for the sake of those tuning in and as they continue to join the webinar, maybe if you can give folks a quick background on who you are and how the heck we got you up this early in the morning in Chicago.
Sure. Thanks very much, Frank. Yeah, Mike Gould. I'm a partner based in Chicago in the US. Work for PricewaterhouseCoopers in our capital markets practice. Actually run our IPO services business. Been with PwC for over 30 years. In that period of time, seen thousands of transactions, worked on lots of IPOs. I've really done this my entire career. I've done this, started with PwC in London, the US. I actually did a tour in Seoul, South Korea, now back in Chicago. Enjoying the current run of the markets and the SPAC boom.
Good stuff. Well, Michael, I think on that, and I'm sure we'll have a few moments of some sarcasm as we move forward. And for the sake of those tuning in, the format today is going to be pretty straightforward. Michael and I have promised everyone that rather than this being a hypothetical 50,000-foot overview of SPACs, that we actually would get into the weeds today and try to make this as best we can a working meeting for both target companies and for sponsors. So in regards to that, as we're presenting today, forgive us, we may be somewhat loose in regards to going back and forth on slides based on the tone and tenor of the conversation. We could easily be here today on the webinar for hours. I promised Michael that we would keep kind of the more quality time of the presentation to about 20 minutes. We'll open it up for Q&A throughout, but we should be done somewhere between the 30 to 45-minute mark on the day. In terms of next steps, depending on how today goes, Michael, the bad news is that we did a grotesquely poor job of planning for this. So as it turned out, we in the interest of keeping the Q&A tight, we had, and I'm not exaggerating this, we literally had hundreds of people very, very upset with our firm. I think the total attendees for today's seminar was just over 2,100 individuals. And with that, it's obvious we're probably going to have to do a next one and think about how to open up the Q&A even further. That said, in April, just one little plug on our side with our firm. As you know, we're based here in Singapore, and on April 27th, we're conducting a US SPAC trade mission with the US Department of Commerce, where we're going to be bringing out the 10 largest US SPACs and facilitating a trade conference and trade mission with them and the potentially 10 largest target companies here in the region. So with that, Michael, we were joking ahead of time that where does this go? Because I think when you and I were speaking in our last webinar that we did, the question was asked, is this the end? Is the market at a high? But based on new issuance, it looks like we might be eating our words pretty quickly.
Yeah, I mean, we're certainly seeing in the US, we're seeing almost every company I've had on my radar screen for the last 5 or 10 years as being approached by a SPAC. Any company that's been looking at a potential IPO listing is seeing activity. It's interesting when the SPACs approach. Some companies are ready, some aren't. They've got multiple. We're seeing SPACs approaching multiple companies at the same time, and these companies are also being approached by multiple SPACs at the same time. So it's definitely the most buoyant market I've ever seen in my 30+ career.
And Michael, how much is this? I think, again, I'm teeing up a softball here for you, so forgive me. But when I talk to folks on the fixed income side, they see 100% correlation to what's happening in the SPAC market to the shape of the yield curve. So to the degree that rates move, is that really the bellwether for when we should start to look over our shoulder and say, hey, this might be slowing down?
Yeah, it's hard to tell. That's probably not really my area of specialty. All I can tell you is, my client base, significant volume at the moment, and everybody, even if they're not actually actively pursuing a SPAC, they are being approached, and there's really no sign of it slowing down. In fact, when I sort of broke for the holiday break just before Christmas, I kind of took tally of all the companies that we had on our radar screen, and I felt like, wow, this is a significant volume, never seen this before, and it's probably tripled just from December through to where we are now, the beginning of March. It's unprecedented.
Why don't we do this for the sake of our listeners and those viewing today? Why don't we wear two hats today? And what I thought I would do real quick, I'm going to put up a quick slide that will probably be woefully inadequate and grotesquely too simple. And Michael, can you see this here in terms of this
I
rather
can, yeah.
simplistic diagram? So maybe if you can, why don't we give our viewers a quick overview and walkthrough of what a SPAC transaction looks like, and maybe we could take this from two sides in terms of both the target company, the sponsor, and I think the third leg of the stool that people don't talk about enough are the PIPE investors. So if we look at this from the sponsor side, if we go to the top left, so you're now someone who thinks that he should be a SPAC sponsor. Can you talk a little bit about who at the end of the day should really be looking in the mirror and saying, okay, I should do this? And then maybe we can walk that through the rest of the transaction here.
Yeah, maybe that's probably even better for you to answer. You know, my involvement is obviously kind of at the company. So, you know, I spend all of my time getting engaged by the company that's going to be approached by the SPAC, and then, you know, helping them get ready for this tirade of investors and interest that they're going to see, and then kind of what it means after they go through the SPAC, the de-SPAC transaction. So I'd be happy to talk about that, but I think you might be better placed to talk about the investors and the pipe investors, etc.
No worries. And I think along that, to add to Michael's point, so one of the things that we're seeing, and we were joking ahead of the broadcast today, that it's been interesting to see the composition of who today are becoming sponsors of SPACs. So in effect, who are becoming the management team of these entities. And today it was brought to our attention that there's some interesting folks in the entertainment industry, not the least of which was Sammy Hagar, who is now a SPAC sponsor. So it gives you a sense as to the liquidity in the market. But key to this, and what you'll hear from many of the target companies that Michael is referring to, is the importance of how that security trades after the transaction occurs. And the transaction being the merger, or what folks refer to as the de-SPAC process. So that SPAC investor, or as we should say, the SPAC sponsor, it's very, very important that the market perceives them to be credible and that they have the domain expertise in the particular vertical that they're focused on. And with that, one of the phenomenons that you're seeing in the market is what we call as serial SPACers, where folks are now in the market for 2, 3, 4, or 5 transactions. And with that, Michael, why don't we go to kind of role play here. So now to your point, the SPAC investor has raised $200 million through an investment bank. They've constructed the entity. Now they're out there looking for target companies, and how have you seen that dialogue unfold, and what are some of the things a target company needs to be thinking about?
Yeah, that's great, and it's that's really the area I spend sort of all my time in these days. We typically get engaged by these companies that are thinking about a capital markets transaction. Typically, when we get engaged, they haven't yet been approached by a SPAC, or at least we hope they haven't been approached by a SPAC, because they've got a lot of things to do to get ready. And we sort of essentially help them think through what's going to happen when they get approached by that SPAC. Typically, what we see is when they get approached by a SPAC, the SPAC is looking to sign an LOI, and that LOI will sort of require that company to file a document with the SEC in the US in a very short space of time. When this really started to bubble up a year ago, I would say, you know, 60 days seemed like the average. It quickly came down to 45 days. And to be honest, in a couple of my transactions at the moment, there's a couple of banks out there that are saying, you can do this in 2 weeks. So the accelerated timeline is very real. But, you know, most of the time, these companies, you know, they need a lot longer than 60 days to get ready. So we like to approach these companies and help them get ready well in advance of that SPAC transaction, or even being approached by a SPAC. And there's a whole bunch of things that we can help companies get ready, and we typically see companies needing to do prior to being approached by a SPAC, so that when they are approached, they can actually have an intelligent conversation, they can enter into a negotiation, and they actually feel comfortable that they can file that document with the SEC in a pretty short space of time.
And Michael, you're bringing up some good points there, because one of the questions we hear a lot from the target companies, and ironically, because of the fervor in the market, it's almost at the end of the day, even though you might not be overtly looking for a SPAC, if you're within the right criteria, there's a high probability you're going to get the phone call. And I like to use the quote that when Lady Luck comes knocking at your door, you better be sure that your bags are packed. What if we can get into the weeds a little bit more, because that LOI is really, really crucial. And sarcastically, I've heard people say that, these SPAC sponsors have the attention of a goldfish. So if they don't hear certain things quickly, they're gone. So if you're the target company, and let's assume the worst case scenario that you're actually not ready, you're getting this reverse inquiry that you did not expect. For lack of a better metaphor, what's the fire drill that they need to be thinking about in order to get ready? And let's assume that the SPAC actually is a conversation that they're interested in.
Yeah, great question. So the first thing, typically we're approached by a CFO that thinks this may be on the radar screen, or even worse, they've been approached by a SPAC and they're like, where do I start? Typically, we see a lot of work in the financial reporting and accounting area. Most of these companies are, private companies that have been audited with a private company audit, and they need to, first of all, upgrade those financial statements and that audit to get at least 2 years worth of financial statements. So what that generally means is a fair amount of work around what are the key accounting policies, documentation of those accounting policies, upgrading the financial statements to include disclosures that would be required by the SEC, and then getting the auditors to go through that incremental audit, taking what we call a PCAOB audit. And for most companies, that's a few months exercise. That's not something that can be, shortchanged into a, 60-day time period. I mean, it's 3+ months at a minimum to do all of that uplift. And really that's the blocking and tackling. That's kind of the starting point, because you're going to need to include those financials in your filing with the SEC. And if you're not ready with those financial statements, you're not ready with that audit, it's really hard to squeeze all of that into a short LOI period. The next thing that I would say companies, typically have to focus on is, thinking about becoming a public company in the finance area. So most private companies, they don't close their books fast enough. They don't have the internal control structure to close their books. And, when you become a public company in the US, you have to file Qs, Ks, 45 days to file that Q. That comes along very quickly, and most companies aren't ready for that. So again, it's not something you can switch on overnight. It takes, several months to get the company to the point where they can close their books quickly enough, do all of the incremental effort that they need to get those financials ready to be able to be a public company. And then linked to that, obviously, is internal controls. In the US, to be a public company, there's a lot of requirements now, what we call SOX, SOX-related activities, where companies have to go through, assess their internal controls, and essentially give comfort to the market that those internal controls over financial reporting are operating effectively. At a minimum, prior to that first SEC filing, they have to go through and identify their key controls, figure out if they have any gaps in those key controls. If those gaps raise to the level of what we call a material weakness, they have to disclose them. Again, that's a 2 or 3 month exercise that it really can't be, can't be shortcut. All depends on the size of the company, complexity, what systems are involved. But again, everybody has to go through that exercise. And then they have to think about becoming a public company, what it's going to mean, and how quickly can they close their books and put those internal control certifications in place. Couple of other things I'd throw onto the list is most companies don't have a financial planning and analysis, an FP&A group that can produce projections at sufficient detail that's going to be required by sort of the SPAC, or even put guidance out as a public company. And then that guidance or those projections have to be generally further out and in more detail than they've seen in the past. And then they need a team that can sort of analyze the differences between historic and those projections. So we generally see companies taking several months to upgrade their FP&A group. A couple other things I'd add is tax. tax structuring, particularly for these SPAC transactions, is starting to get very complicated. We're starting to see a number of tax-motivated legal entity structures being put in place to effectuate these IPOs through a SPAC. Those are not things to be taken lightly. It takes a fair amount of time to design the structure. Then you have to implement it, figure out the sort of accounting, financial reporting, legal implications of that structure. And all of this has to be done before that first filing. In a traditional IPO, you get a little bit of time to sort of put some of these things in place. But in a SPAC transaction, essentially it all has to be ready to go in that first filing. And then the last thing I'd say that perhaps catches people off guard is in the HR and executive comp area. Most private companies haven't gone through the diligence. They certainly aren't ready for all of the public disclosures that they're going to have to put together to disclose their executive comp and benefits packages. So taking some time, doing a benchmarking study, comparing where your policies are at compared to that benchmark, make sure you're not sort of above or below the line, and you're really ready for that bright line or that bright light to shine on your executive comp practices, and make sure you're sort of ready for public time. So, a traditional IPO, we would typically say these things take a year or two. In the SPAC world, everything is moving at lightning speed, but it still takes, 3 to 6 months to go through a lot of this preparation and get these companies ready. So in other words, you can't wait until you get that call from the SPAC. You have to be well down the path on all this stuff prior to getting the phone call from the SPAC.
And Michael, to that end, we've been getting a few questions here that so one, and also I think you have a few slides that you should feel free to bring them up if you wanted to share them. And one of the questions that's come up here is a local CEO has asked, from a resource perspective, how much of this can the company do themselves versus how much of the heavy lifting could a PwC do for the firm? So yeah, versus because again, I think this is a question we hear too in terms of staffing and resourcing, is in terms of how much of the load can be picked up externally.
Yeah, I will share a screen. Hopefully you can see that. It does sort of perhaps help to illustrate what I was just talking about. So I really just went through the areas that companies typically need to beef up or create as they think about becoming that public company. And to answer the question specifically, a lot of this stuff can be outsourced. I would say in a SPAC transaction, you first get the call, everything gets super accelerated, and you really don't have time to hire internally. So if you think about kicking a process off like this, you're probably going to lean on significant external resources. And then, as you get chance to sort of build some of your internal resources, you hire a couple of sort of finance, accounting type people, maybe a couple of key hires in FP&A, maybe an internal audit resource, HR resource, and over time you can kind of wind down the consulting expertise. But certainly if I look at that top row, which is what I just went through, accounting, financial close, FP&A, internal controls, tax, executive comp, and HR, I'd say every company I deal with, they outsource a significant amount of those, at least initially. And then as they get time, maybe they send in the first filing, they're waiting for comments, they're heading towards the close, they get time to sort of advertise and bring in some internal resources. But these projects are so accelerated, you really don't have time to go from the private company standstill to 100 miles an hour overnight. You need some help to get that engine running and get a lot of these functions where they need to be ready to be a public company.
And Michael, to that point, one of the things that I think would be worth sharing, and this is something that we have found with you and your team has been a fantastic resource, is the concept of a readiness assessment. So let's assume that listeners after today are going to say, okay, wait a minute, I know in my heart of hearts, so if I'm the CEO of this private company, I know in my heart of hearts that I'm going to need all this. Do you have the ability to provide a snapshot ahead of time to just say, hey, how far downfield are you versus, because again, there's certain assumptions there on the timing that you're making, but do you have the ability to give them a snapshot even earlier to say, here's a readiness assessment as to where you are?
Yeah, and this would apply whether it's a SPAC transaction or a traditional IPO. We generally think about organizing the the efforts into two primary work streams. I think about going public, sort of the box I have there in yellow. That's the immediacy around getting the registration statement together, working with the banks and lawyers, ultimately sending a document to the SEC, doing the roadshow, getting the money in the door, as it were, completing the transaction. But I think what a lot of companies miss is the concept of getting the company ready to operate as a public company, what we call being public. That's the pink box there. For a traditional IPO, that's minimum 6 months, maybe 9 months, and we typically would say companies are a year or two in advance of that in what we call a state of readiness. And we would certainly recommend at the start of that, when you start thinking this is on your radar screen, doing what we call an IPO readiness assessment. And it would go through everything that I've just talked about from a going public perspective. What are the issues that are going to come up? What's the information that you need to gather? What questions are going to get asked by the diligence from the banks, the public company auditors, the SEC, and then also thinking about being public. As you think about that framework that I just went through, these are all the areas that companies typically have to beef up, or in some cases create from scratch as you think about becoming that public company. So I would certainly recommend, hire us, hire another firm, but maybe do it internally. But before you go too far down this path, you really need to do a gap assessment and think through kind of what are all the things, what are the issues, what are the gaps, what are the changes in the organization I need to make to get this company ready to be a public company. And this is the framework that we use. I would say a lot of the heavy lifting is probably on the top row there, but don't forget the sort of second row, investor relations, new governance requirements, new treasury requirements, a lot to do in the legal and compliance area. A lot of these functions that we talk about here have new systems requirements. And, I would say generally, whenever you identify a new system that needs to get put in, that generally is a longer lead time activity. Generally takes a fair amount of time to put in a new system. If you're thinking about a new ERP system for accounting, you're thinking about a system to help you track internal controls, even a system to, in the HR world to track exercise of options, etc. Needs some time, needs some planning to put it in. And the final thing I would say, and the key thing about a readiness assessment, is it's really your gap assessment. It's the sort of start of your project management. You're never going to sort of get through all of this, and most people have a day job to run at the same time. They're not 100% focused on getting ready for this transaction. Managing your way through all of this is really difficult, and clearly our recommendation is to put in some strong project management principles. Do a detailed gap assessment, think about what's a detailed project plan in each of these work streams, and then have regular checkpoints so that each of these work streams are being monitored, who's falling behind, who needs resources, who perhaps is waiting for a decision higher up in the organization. But clearly put some strong project management principles in place so that ultimately you can get to those key milestone dates. And what I mean by that is, in a transaction like this, the kickoff meeting, or the signing of the LOI, when you first get approached, you really want a lot of this done before you're even approached by the SPAC. The second milestone, obviously the first filing, even if you don't get it done for the kickoff meeting, you really need a lot of this stuff done, if not all of it done, by the first filing. And then closing in a SPAC transaction, when you become that public company, when you ultimately take over the parent company that's the public company, there's a lot of new requirements that kick in on closing. So you need a project plan that keys off those 3 milestone dates.
And Michael, let's take advantage of your experience. You alluded earlier to the tremendous breadth of the organization in terms of the number of transactions you've had the opportunity to work on. Where do you see it going wrong? Where do you see a transaction moving sideways? I would imagine at this point you could probably rattle off some real quick, I don't want to say mistakes, but maybe oversights that target companies might make in this.
Yeah, there's a lot, unfortunately, and I would say, order of magnitude. If I work on, or I talk to 50 companies, 5 of those maybe start the process, and only 1 of them gets there. I mean, there's a lot of companies that have this kind of stuff on their radar screen, but there's a lot to do. I would say the first thing is setting an unrealistic timeline. Many companies, they start down this path and they just underestimate the effort. They set an unrealistic timeline, which means that somebody is disappointed. Either you miss the market window or you're not ready. Hopefully you don't get to the point where you launch and you're a public company and you're not ready, because then you generally will miss earnings guidance, earnings expectations. Maybe you can't get your financial statements out. You have surprises, internal controls. So I would just say underestimating the effort and putting an unrealistic timeline is probably the number one. A couple of other things I'd say that really, slow this process down: acquisitions. If you've been fairly acquisitive in recent history, there's a lot of compliance requirements that kick in, where you need to get audited financial statements of significant companies that you've purchased prior to the date of acquisition. Maybe you need to put pro forma presentation together of those acquisitions. So acquisitions really make this process complicated. And if you're still trying to engage in acquisitions or M&A activity while you're going through a transaction like this, that makes it extra complicated. And then the final thing I would throw in there is just the tax. The tax restructuring, I would say, it's hard to say no. If you're an owner and you see an advantageous tax structure that gives significant additional value, you're going to want to slow the deal down to make that happen. But some of those tax structures can be extremely complicated and just take a long time to put in place. And the SPACs and maybe the market doesn't have patience for some of that stuff. So it sort of passes you by as you're trying to get some of your back office structuring, or even get kind of ready to be a public company. So the answer to all of that stuff is, if you think this is on your radar screen, do the readiness assessment now. Figure out what the gaps are. What are the issues that are likely to come up? And you can plan around all of these things. With enough time, you can make it work. But if you're waiting to be approached by a SPAC, chances are it's going to be too late to fix some of these things.
Well, Michael, it seems like you've struck a nerve, because we've had a few questions here. So forgive me if some of them sound the same and similar. As some of or I should say, as the majority of the folks listening today are from out here in Asia Pacific, one of the questions that's come up is are there issues as it relates to a company here in region merging with a US SPAC, over and above the issues that you've highlighted already that they need to be aware of?
Yeah, a few things come to mind. What we're going to have to figure out, presumably the SPAC that's approaching you is already registered in the US and is what we call a domestic filer. When they acquire the company in Singapore or in Southeast Asia, that company could be a foreign private issuer. So the first thing we need to figure out is the combined entity as a future public company. Are you going to be a US domestic or a foreign private issuer? Because that's going to drive the forms that you file, the timing of everything that's required. And from my perspective, one of the key requirements is it going to require US GAAP financial statements or IFRS financial statements? If you ultimately end up being US domestic filer, you need US GAAP financial statements. And I would imagine that that's going to take a fair amount of work for most of the listeners here to convert from whatever they have for local GAAP, if it's IFRS or something else, into US GAAP financial statements. So I'd say that's probably top of the list.
And Michael, a few other questions here. I'm going to aggregate this one because it's come through 4 different ways. But there seems to be a palpable concern on individuals listening today regarding the timing of the process you outlined. And I'm going to stop screen sharing here in case there's another slide you wanted to show up in regards to this. But it seems that if I could speak for the group, that they're not ready. And they know they're not ready, and they're already getting inquiries from the SPACs. So I think as politely as we can, how do they start thinking about triaging that relative to Lady Luck did come knocking at the door and they're halfway packed with their bags? And if I had to summarize, those 4 questions, I think that's the tone and tenor of what's there.
Yeah, maybe just to answer the timeline for a minute. So if you look on this particular slide, the lower half is a traditional IPO. And you can see, as I talked about, companies generally are in this sort of state of readiness for longer. They kick off the process, they'll file an S4, an S1, they'll go back and forth with the SEC, roadshow pricing. Typically we say that's a couple of year process. In a SPAC, environment, sometimes the first you hear about it is you get approached for that LOI.
Right.
And like I said, you generally are looking to file that LOI within, 45, 60 days is generous these days. You go through the SEC process, backwards and forwards. You have the shareholder vote, you close, but you're generally talking 3 to 5 months. And right there, even just start to finish to close, it's a very short process. So if you're not ready, at the time you're approached by that SPAC to sign the LOI, it's very, very hard to catch up. And again, if I go back to the sort of the topics, accounting, internal controls, tax, executive comp, HR, you can start on all that stuff now. There's no reason why you can't think about accounting policies, figure out do you have US GAAP financials, do you have IFRS financials? If you do, are they ready for sort of SEC prime time? There's a lot of this stuff that can sort of be started even when you don't have a SPAC interested. And I would say the majority of my clients, quite frankly, even the ones that are aggressively going after a SPAC and they're hiring a bank to go find a SPAC to acquire them, they're starting down this path well before they've got a specific SPAC in mind. So yes, it's tight. It's a very much an accelerated timeline, but there's really no shortcut around the stuff on this slide. You've kind of got to think through each of those work streams. What do I need to do, and can I start it now?
And from their standpoint, and again, assuming they did get the phone call and they call you up and say go, what type of timeline are they looking at where on the one hand they're going to be having that conversation with the SPAC to drive to an LOI, but it sounds like at the same time they're going to be in a hurry up offense with you to try to get as much of this done or in process as they can?
Yeah, I mean, it's tough because I feel like that the owners are under pressure to close the deal. They want to appease the SPAC, or they want to enter that LOI that gives them the requirement to file the document in 60 days maximum. But then I typically find CFOs, they're sort of pushing back, saying this is just not practical. There's no way we can get there in 60 days. So I've got into many discussions over timeline, and it gets back to the answer to one of the questions before. If you set an unrealistic timeline, you're only going to disappoint everybody. So the first thing up front, once you getting approached by that SPAC, is be honest about your readiness and how long it's going to take you to get to the point of being able to file, because you can't tell them you'll file in 2 weeks if it's going to take you 3 months. That'll just get everybody upset, and you won't get anywhere in a transaction like that.
And Michael, to your point, and we're seeing something interesting out here where the question has come up I've had this in a number of conversations. I've had this, the exchanges have talked about this as well. And I'm not sure, forgive me, I'm not sure you can answer this, but to the degree you can, what size company should be having this on their radar? Because it's been fascinating to see when you talk to sponsors, you'll hear people quickly say, it needs to be $1 billion, $1.5 billion in terms of the ultimate transaction size. And then depending on who else you talk to, you actually hear folks saying, no, it can actually be smaller than that. But from your experience, is there an efficient size where to your point, if you're the CFO of X size company, this needs to be on your radar?
Yeah, I'm definitely seeing deals smaller than that. I don't know, kind of what would make a Southeast Asia company different, but certainly the SPAC size deals that I'm dealing with, from a valuation perspective, 400, 500 million up, right? Doesn't have to be $1 billion in value, it seems. And also, given what's going on in the world with COVID, et cetera, we're seeing some very, very unique transactions. I've got 3 clients that I can list off where, for a variety of reasons, they just really haven't had much revenue in the last 12 months. But they think that when life gets back to normal, everyone's vaccinated, not only will their business go back to where it was previously, it will be much more accelerated, and people will be more interested in going out to restaurants, buying tickets to, events back in sort of normal life on an accelerated pace. So they're translating that into a story that, yes, I have very little revenue now, but my growth rate's going to be way accelerated from where it was in the past. And that seems to have got, a lot of these SPACs excited. So I've definitely seen, in the consumer space, the tech space, tech related, even in the fintech space, I've seen a number of companies that I would have thought, need to wait a couple of years for their revenue to come back. They're going through, hot and heavy SPAC negotiations, and there's, numerous SPACs out there that are interested in businesses like that. And they're like I said, they're not, billions of dollars in market cap. These are, 3, 4, 500 million maybe valuation, maybe less, based upon their current market conditions. But they're making the argument that skip a couple of years and my revenue's significantly better than it was last year.
Well, and to your point, that's also one of the other benefits, is that the unlike an IPO, the SPAC can use projected financials,
right?
So which is a huge plus. And maybe too, based on one of the interesting things that we've seen on our end has been for especially for the folks in corp dev and the CFOs, where they're realizing from a source of capital perspective that, to your point, even relative to a traditional fundraise, that the SPAC process is actually more, in many cases, more efficient in terms of capital raising. So to your point, smaller companies could be looking at, so it's not $1 billion, $1.5 billion. It could be a smaller company. The other benefit is that relative to an IPO process, it's faster, although maybe a lot of overlap in terms of the technical issues. And then from a capital raising standpoint, we could also make the argument that it's actually faster as well. Where else do you see? Again, because I'm noticing here some more questions, and it seems like we have dueling banjos between CEOs and CFOs. There seems to be a general sense that folks feel that they're not ready, but they feel they have to be ready. So what's the worst case scenario, if I had to aggregate this theme of questions, where if the CEO realizes he needs to do this, what's his best case scenario right now? So he calls you and says, I need this readiness assessment. How should he be thinking about that timeline from that point forward? And let's assume you and I are bookending the transaction. So now if I'm wearing my working hat, I'm the guy calling him up saying, look, you've got 6 SPACs that are really interested in talking to you today. So how could we manage his expectations? Because I think your point on timeline is resonating with folks, and some of the folks feel like they're behind the 8 ball now.
Yeah, I'm sure they are. Every phone call I get in this market, in this space, everybody's behind. What I talked about before is that concept of doing a readiness assessment. That works in a traditional IPO. It also works if you think this is on your horizon. But if you get the phone call from a SPAC and they say you've got 6 weeks to file a document, and you have to do that because of the valuation, market conditions, whatever, what we're finding is you just have to kick all this stuff off in parallel. I would do there's some things that I, without really knowing the company very well, I know they're going to need to beef up everything that I talked about in the accounting department. Probably don't have the accounting policies, probably don't have the ability to close the books. So we would start that sort of right away. The internal controls assessment, figuring out the key controls, I would start that right away. I wouldn't wait for any kind of gap assessment to get going. I would also start with sort of a detailed project plan. And then as part of that project planning exercise, if you've got smart people appointed in each of those work streams, you can kind of do that readiness assessment as you go. What I mean by that is, you set up a PMO office. If they know how to do an IPO, they know how to do a SPAC, they can go sort of interview the accounting folks and really put that project management or that project plan together, as they're going. Don't even wait for the readiness assessment. And try and do as much of this stuff in parallel as possible. And again, you can really only do that with consultants. You're not going to be able to staff that up internally. The challenge becomes is, even if you wanted to start all of these work streams at the same time, and you had, a team of consultants in HR and accounting and internal controls and tax, which is what a lot of these do. The finance team or the CFO or the company that needs to control this, sort of the virtual line outside of that CFO's door forms, and there's only so many consultants you can manage to get through a transaction like this, which is really where the rub comes. And if you get that LOI signed, you've got 6 weeks to do it. Yes, you can parallel path as much of this as possible, and we've got many clients right now where we're trying to do that. We're trying to do accounting and HR and write the document all at the same time. But there's only so much you can sort of shrink that, because the information lies generally within a few key employees of the company, and all of those consultants need to suck that information out of those employees. So there's I can think of one client I have right now, a fintech, where the CFO, she's working 24 hours, 7 days a week, and really all she's doing is answering questions with consultants and trying to give history and trying to give information to those consultants so that they can try and do all of this stuff in parallel. The company employees end up just directing traffic. They're not writing memos or writing business section or writing documents. They're literally just trying to direct the traffic, the consulting traffic, and it's expensive, it's stressful, and it's not really the ideal way of going through these transactions. If at all possible, you've got to try to get a little bit of heads up. You've got to try to get ready and try and do some of these things in advance of getting that phone call. But we understand life works. You get the phone call, and we'll react as best we can.
And Michael, to that, and I think this would be a good wrap-up question, because I think this question actually best can encapsulate a lot of the themes here. How many of the issues regarding the workflows we're discussing today are actually due diligence items that would impact evaluation? So the point here was the CEO is asking, this sounds like this is required, procedural for the company to be a listed company, but at the same time, does it derail the valuation intent of the transaction? And if I can infer within the question, the view being, hey, and I don't mean to put words in this person's mouth, but I will. To the degree that the LOI is there and there's intent on both principles to say, okay, for argument's sake, this is now $1.5 billion transaction. These workflows that we're describing for the CFO, are they predominantly procedural? But I mean, and understanding that they're required, but
yeah.
Versus
no,
how many?
I understand the question. Yeah, I would say a couple of them. So if you think about the FP&A group being able to put projections together, to me that directly impacts any valuation, any conversation that you're having. It's really hard to have kind of a substantive discussion with any potential buyer if you don't have confidence in your models. So, if you're putting kind of that projection or those models together sort of live in front of the SPAC, chances are, they're going to take a haircut. They're going to take a discount on, kind of what you give them. I'd say there's a number of things that are perhaps indirectly related. So, for example, internal controls. Yes, it's a requirement. You've got to put sort of certain certifications in various filings. And if everything goes to plan, it doesn't impact valuation. But if there's a surprise and, 3 months into the transaction, you get a surprise in internal controls, there's a material weakness, or there's a restatement of financial statements, or you miss some sort of key metric, then yeah, it very much impacts the valuation, and it very much sort of impacts the conversation you're having with the SPAC. So I would say some of these things are direct and some of them are indirect. And even the indirect ones, it's okay if it goes to plan, but if things don't go to plan, you don't get the financials filed in time, you have a surprise on internal controls, the tax structure goes away, goes awry, and all of a sudden you've got a charge somewhere. Yeah, then you're going to have an impact on valuation. So it's hard to prioritize, because I think ultimately everything has to get done. Very little of what I've talked about here is like a nice to have. We typically get into this conversation of, okay, I just want to know what must get done. I'm like, everything. Well, no, there must be some things that are nice to have. I'm like, well, I'm not really giving you much luxury here. Everything we're talking about is, it has to get done. And maybe it depends on which of those 3 milestones. And again, I would encourage people to think critically around, what needs to get done before you have that conversation with the SPAC or sign the LOI, what has to get done prior to the first filing, and what can wait or at least get done, prior to pricing. And if you sort of think about those 3 milestones, everything we've talked about today is, certainly, prior to pricing, and most of it, quite frankly, is a nice to have before you even have the conversation with the SPAC. So maybe that's a way to finish.
No, that's perfect. And Michael, again, it's funny, as we've been talking, it's been interesting to see the pace and cadence of the questions. So this could have been 3 hours long. So for the benefit of everybody, as promised, we committed to Michael that we would cap this at 45 minutes. Michael, this has been a fantastic conversation. For those attending today, thank you very, very much for your time. What we're going to do is we have recorded this session. The session is available. Michael's contact information will be available, and you can feel free to reach out to him and his team. And on behalf of everybody on our team here at SoHo Advisors, we thank you very, very much today for this enlightening talk. And Michael, again, thank you. And I have a feeling in a couple of months, again, we'll be looking at issuance saying, oh my goodness, it went even further. And thank you again for your time here today. We greatly appreciate it.
Thank you.
Thank you, sir.